Hello, Oak Bloke here, and we are going to talk about ASA International. So, I'm going to share this on screen. So, this is one of the Oak Bloke picks for 26, and those of you who have read this prior article, it as AI, you see. So, it's obviously some funny little play on the as AI. S- Someone said to me the other day, I only just got that months later. So there we go. Maybe somebody else will watch this and go, oh, yeah, yeah, I see what you mean. Yeah, it's not that funny. Anyway, um, so we're going to cover ASAI. I've written this article and this will be published on my Substack in the next days. So this is my Substack, theoakbloke.substack.com. And yeah, so what I've done is following up from this article, really, I wrote this on 1st of August, and at the time there was no 1H25 result, there were no 3Q 25 updates. And I've kind of, it's one of these things like the phone rings, you're busy, this happens, that happens. So I'm kind I sort of sped read the interim report, looked at it and thought, looks good. I sped read the 3Q25 results, looked at it, looks good. There was then last week an update from the company saying, yeah, that we've essentially we've got another little bit of news that we are going to be substantially ahead of results. So if I just maybe just show you this. So momentum in the first half of the year remains positive, improved. Um, that net profit will significantly exceed the currently consensus of 48.3. So there's been quite a lot of news in the last couple of months, 4 months. Um, yeah, I sort of took the opportunity to really sit down today and get my head around what's changed, what's is it just the same story or has it changed quite substantially? I think this sort of tells you a lot of what you need to know in a few seconds, which doesn't often happen with me. That back when I included it, the market cap was that. Today it's that. So it's gone from 127 to £2.04. Do I think you've missed the boat because it's at £2.04? Well, obviously you make your own investment decisions on all of these things, but I think hopefully what you'll see today is that this is actually still a very, very, very good price. Now, this dividend is based upon last year's dividend, so I've not speculated as to what that might change to in the future, but you'd imagine that a progressive dividend wouldn't be beyond question. But based upon the yield as it was back then was 4.2, today it's 2.6, unless that increases, which I think there's every probability that it will increase. Um, this as well was something that caught my eye. So the NAV when I looked at this in August was £72 million. Today, based on the 1H25 results, the NAV jumped from 72 to 102. So that's quite a big jump in shareholders' equity. That actually implies a 100% compounded annual growth rate, which is pretty good if they can keep that going. If they can keep that going, and let's start with some real basics. I mean, ASA loans money to low income people, so they are essentially loaning money to people that are earning between $3 $5 per day, entrepreneurs, mainly women, in Asia, Africa, and it's loans to help them start a business or to grow their business. But there's also the idea that they can save money with ASA as well. And in 2025, they've also introduced insurance, which in the 1H25 results, there was no sign of any financial result. There was a brief mention of the insurance, which is I've got the interim report here. So they talk about it here. Launch of our ASA Life Care. Look forward to expanding into all of the African markets, and yeah, and they talk about ASA Uganda has entered into an agreement, but in this other operating income, we don't see any actual income from insurance. So it's talked about, not, but I mean, it is a classical, I've sold you a loan, now do you want me to sell you insurance, so that if something happens to you and you can't repay your loan, you can still, but this is, I would say the insurance is a life cover and a income protection cover, so it's not just necessarily to do with repayment of the loan. Um, it's a more broad policy that can cost, 30 cents a day, something like that, which obviously is still a lot of money for somebody earning $3 to $5 per day, but just gives them that peace of mind if something happens to them, that they can still, essentially the insurance policy would pay off, or pay them a lump sum, or pay off the loan, or whatever. So anyway, that's kind of an overview of what they are, who they are. Um, yeah, so as I say, 100% compound net growth rate. Can it continue, or or is it accelerating? Well, we'll look into that. The other thing that kind of caught my eye in the report, in the interim report, was that loans had increased by 21%. So you can see here they've gone from 400 to 500, roughly, and that, that was supported partly by higher deposits, but also by higher loans from lenders into ASA, as well, so bank debt and so on. So yeah, I suppose the thing that I mean, you can look at this two ways. You can look at it, well, they do charge very high interest rates to their customers, to their clients. Um, okay, but 94% of the time, the loans that they're making increase the income of the person they're lending it to. So to me, that's a win-win. So I guess you've just got to be happy about that in yourself. That I mean, yes, they are charging high rates, but then they're charging high rates to people who can then use that money to improve their lives, improve their businesses, and the loans pay for themselves. So 94% is, feels like a fair result, and obviously 6% of the time, I mean, obviously it's down to the individual or down to the business to make use of the money wisely, and not go and enjoy yourself with with the uh, with the money that you've received, that you invest it back into your business and so on, which majority of the time is exactly what's happening. Okay, let's move on. So yeah, so I suppose at the time I wrote the original article, one of the things that massively caught my eye was the 35.2% net interest margin. Um, so, I mean, I guess one of the things that I skim read but didn't fully appreciate until I got into the detail was that had actually gone up by a lot. So in 1H25, the net interest margin was 39.6, and I just like it, that is an incredibly good number. The return on tangible equity was 46.1%. I mean, this sort of level here is almost unheard of. I mean, it really is, um, far above the profit levels achieved by your average UK bank. I'd say about four times more than they achieve. And Bank of Georgia is, or Lion Finance, as they're now called, Lion Bank maybe. Yeah, but even those guys, I think their ROTE is something like high 30s. So 46% is well ahead, well ahead. Um, and it's not just about having a high margin, it's about, can you grow the volumes as well? Because obviously if you're growing your margin and you're growing your volumes, well, your profits are growing doubly fast, aren't they? Because you're selling things at a higher price and more of it. So that's very exciting. So this chart sort of shows you that yes, costs are going up slightly. Um, that yield is going up substantially. So this gross yield of 48.4, which led to that net interest margin of 39.6. And you can see here that that is largely being achieved through just improvements in income. Okay, so how do they work? So essentially, somebody will go to a branch, and there are several thousand branches across the various different countries. They will loan the money, and then they make repayments. And there's kind of a bit of a village community feel about these things. You know, there's sort of meetups, and people tend to sort of know each other. The loan officers are from the community that they serve. So this isn't kind of, I suppose, it's much more sort of traditional model that they operate. And I guess the fact that people know each other, and that it's yeah, people that maybe have gone to school together or something like that. That I suppose that. Um, improves the level at which people will feel obliged to make repayments, whereas perhaps with a nameless, faceless third party, you don't feel that moral obligation necessarily to, you feel the legal obligation. You might not want your credit history to be damaged or something like that, but you don't feel morally obliged. It's kind of like harking back to the days when the local bank manager would would be a pillar of the community, and you wouldn't want to upset that person, so you would sort of yes. So there's a little bit of an element of that, the bygone eras. Anyway, moving on to PAR. PAR, or portfolio at risk, is essentially when people are overdue, when they've not made payments, scheduled payments, they're 30 days overdue. Um, the PAR is and remains very, very low. So when I was looking at it, it was 2.2. At the 30th of June, it was 2.0. I think in the first quarter, when I looked at the first quarter results, it was 1.5. And in the third quarter, it remains at 2.0. So 2.0, very, very good. And this is just people that are overdue. I mean, this isn't bad debt. It's just potential. It's sort of amber, not red. Okay, loan portfolios grown to 555, 2.68 million clients, and all these numbers are up substantially. The loan portfolio is up 32%. Clients are up a large number as well. I think something like 200,000, something like that. So there's some really good progress happening here, and the increase to net income of 969%. Well, that's 10 times the profit, and quite a bit of that is foreign exchange. But nevertheless, even if we sort of say, well, let's not worry too much about foreign exchange gains and losses, but say at constant currency, it's still a 99% increase to net income. Net profit. So some really good, really, really, really good results. 26.8 million, kind of I've used in the article to double that up, would get me to about 53 million for the full year. So comparably, obviously, it's not to say that the second half will be a reflection of the first half. It might not be, but what I've done here is doubled up the number. So actually, if you have a look, just because all of these are full year past years, so this goes back to 2020, 21, 22, 23, etc., that we can see that there's a really good increase in net profit here in the red, and operating profit is steady. Obviously, not sort of spiking upwards anything particular, but nevertheless. And then revenue here also increasing. Okay, and what I'm showing you here next of all was the movement of the cash flow. So these green items. Now it's interesting because since Well, for 10 years, there has always been an increase to working capital. So there's that we're not in a situation where um, yeah, where working capital is decreasing, it's increasing. And increasing tells me that they're loaning more, they're growing the business, and obviously the extent to which these green bars, obviously this swallows up cash. So I guess the orange bit, or whatever color you red maybe, the red bit here is how much cash is the business generating. The green is how much is the business consuming. So I've just sort of charted out this so that we can see. And then the essentially the blue line is then the net difference. So even though that perhaps looks that one looks smaller than that one, and it is, well, you can see there that one's just below 40, and that one's about 80. Yeah, you can sort of see here that I've got sort of the minus sort of 25 for the blue line. And I can't remember why this black isn't at 0, but it's not, so that's a bit confusing, um, to be fair. Yeah, I think it's because I put them on separate axes. Anyway, doesn't matter why. But yeah, essentially, what we see here is that, yeah, um, the sort of it's turned cash positive um, here, and it was cash positive here when they were sort of running down portfolios in 2022 when they were trying to sort of liquidate stuff and free up cash, and that was because of bad bad debt essentially, and that was sort of post COVID that they did a moratorium on repayments, and then yeah, so we see a strong cash flow essentially. These are all the countries where ASA International operate. India, the one here in blue, is one that they're exiting from, but Pakistan, Sri Lanka will remain. They then have West Africa, East Africa, Southeast Asia, and these two here and here. South Asia, India's getting closed down, so India is um, basically going to be sold off for 0. They're just going to close it down, and they're running down the loan book and that closing branches. So they're exiting out of the Indian market. And when you look at the tax level for how much tax they were paying, I mean, it's just not worth operating there. Its tax is something like 70%, and it's a very competitive market. Just absolutely no point being there. Now, what I've done is I've pulled out the loan portfolio growth numbers. So these growth numbers were, if we went and looked at these numbers here, so you'll see. So this one here, this delta here, September 24 to September 25 in constant currency. So, for example, that one there, Pakistan, 29%. Okay, that is, so if we go down to Pakistan, that is that 29% there. So what I've done is I've just worked through quarter by quarter to look at what the last 12-month growth rate looks like. And what you'll see is that, I mean, the Indian growth rates are negative, but pretty much everywhere else is positive, and some places are very positive. Now, because this is constant currency, like regardless of what's going on relative to the US dollar, the exchange rates change, of course. But what I was interested in here is to look at, in Ghanaian CD or Nigerian Nehru, I think they're called. Yeah, I might have the pronunciation wrong there, so forgive me if that's the case. But yeah, in whatever local currency, have we seen increases or decreases in loans in each of those individual countries? So what's very exciting, I think, is very exciting is just the sheer rate of progress in each of these territories, Really, the only one where you could say, well, that's a bit pedestrian is the Philippines. And we'll talk a bit more about some of these countries in a minute. But I suppose the ones particularly to call out were Ghana, Nigeria, Uganda, and I would have said Pakistan as well. Now that 29% there isn't particularly amazing, but we'll come on to that in a minute. What I've done is I've actually just put those into a chart, as you can see here. So these are sorry, no, forgive me. This one is the constant currency one, and this one is the US dollar one. So this one is constant currency as well. So that relates to that chart. But what we see here is in US dollar terms, obviously huge levels, and this is absolute numbers of millions of dollars. So what we see is that in US dollar terms, we've seen a vast increase in the second quarter in Ghana, particularly, and then a shrinkage, or what looks like a shrinkage, in the third quarter. Although, when we look at the constant currency one, well, in fact, let's look at it here. Ghana is still growing, and actually, in CD terms, it's actually 6% higher in the third quarter. So this dip is not actually a dip in local currency terms. But what we can see is Nigeria growing, Sierra Leone growing. Now, some of these, obviously, the scale is sort of makes them look less exciting. But when you look at the percentages, you know, they're still sort of growing substantially. Kenya, Tanzania, Uganda, Zambia, Rwanda, Philippines. Philippines is that's the one that I said is more pedestrian. Myanmar, Pakistan. I particularly call out Pakistan because this is where they've implemented the new banking system. So if the new banking system is also going to help them cut costs and or increase sales, increase interest, then or loan interest, then we'll see it first in or we should see it first in Pakistan. Ghana is the second one to go. Tanzania is the third one to go. So they're kind of going after the biggest ones first. But what we should start to see is, and I don't know whether this is it, because we do see a big spike there in 3Q25 in terms of the outstanding loan portfolio. Um, so we see a jump in growth. Is that down to the e-banking or the new banking app that they've introduced? India's getting run down, deliberately run down, and then Sri Lanka finally. Now, some of these, as I say, they look pretty pedestrian, they look pretty awful, but actually, when you get into the percentages, they're not as awful as they perhaps look in US dollar terms. So some of these with small OLPs. Please also consider the second diagram, so Sri Lanka, Sierra Leone, Rwanda, Zambia. These are some of these are growing between 40 and 80% a year. So Sri Lanka, you can see there that's growing at 60. Um, Sierra Leone growing at 40, Nigeria growing nearly at 70, and so on. Uganda growing at 80. So there's some really exciting growth levels in constant currency terms when you get down into the countries. What I did next was I said to myself, well, okay, here I've got my segmented profits, and I've also got, now it takes a bit of kind of getting your head round. Essentially, I've got these four segmented profits. Then I've got what's called non-operating entities. So these are kind of like my head office or non-assigned, which adds up to 61. And then I've got adjustments and eliminations of minus 35. So essentially, what we're sort of saying here is that like that minus that is sort of like six, excuse me, six about 6 million that or 5.5 million that I need to take from these four numbers to kind of get my true numbers. So what I did to kind of do that was I took what I did was I took the yeah, I took their OLP book size. So I took the 12 month growth rate. I took the book size. So for Ghana, for example, you know, it's 110 out of 135. So it's kind of X percent of West Africa. I then applied the 63% growth um, to basically get me a growth by region percentage. So what that is an amalgamation of all of the individual countries where I'm taking the proportion of the loan book of each country to work out how much of the percentage to include. Um, so there's that. So that's the growth by region. The next thing was this share of segmented share of profit. So what I did there was basically take, what was it last year? So it's 38 last year, 53 this year for West Africa, for example. Um, what I did was I basically took the pro rata of the, again, sort of saying, well, West Africa was 17 out of 32. So it's going to kind of have, of this 5.45 of eliminations, I'm going to sort of pro rata it and take, 53% of that number there is going to get taken off that number to get me that number, the attributed segment profit. So what I wanted to do was get rid of all the head office. I wanted to sort of activity-based cost them, or activity-based revenue them, and I've done the same in the prior year as well. So you can sort of see um, I'm doing that based upon the split of profits. Yeah, so this is the net profit broken out by region, and I've done it based upon like taking out the elimination section and attributing that back. So essentially that profit ends up being that profit. That profit. Oh, well, that number should add up to that number. I've seemed to have glitched it somehow, but yeah, it was only small amount. But anyway, that's kind of what I was aiming to do there. Um, what I also did was say to myself, well, okay, that compared to that, West Africa net income was $5.1 million last year in the first half of 2024. It grew to 14.27 million. That's 177% increase in profit. So that's kind of where I'm getting this net income growth numbers from. So there's a lot of calculations I've been doing that aren't sort of, essentially ASA calculations particularly, but I'm just using their numbers and kind of making my own judgment calls on, like I'm going to pro rata split them. I'm going to do it this way. I don't want to have like head office revenues. I want to just sort of say, let's take the four regions and kind of come up with a net profit split for each of them and a growth net income growth split for each of them. And what you see I end up with here is that if I look at my revenue growth in US dollar terms, West Africa grew by 100% between the first half of 24, first half of 25. In constant currency terms, it was less, it was 63%. But in those two first half comparisons, net profit grew by 177. So you can sort of see, the only one here where we kind of have a bit of a sort of low performance really is Southeast Asia, which is the Philippines and Myanmar. So that's kind of reflective of that previous diagram where we could sort of see, it was a bit pedestrian for for the Philippines. So that's my growth rate in constant currency terms. So that would be the Filipino, what do they have? A peso, I think, Filipino peso, if I'm not mistaken. And Myanmar, couldn't even tell you what currency they use, but and you can sort of see the same. With this one as well. So again, Philippines. Oh no, sorry. This one, sorry. The Philippines. I mean, Philippines is quite. Where's it gone? Down here. Philippines is, it's $60 million. There's quite a lot of it, but it's not really going anywhere fast. Myanmar is growing, so we are seeing growth in dollar terms, but not it's sort of 25, 30%. So it's okay. I mean, well, 25, 30. I mean, this is sort of, when I sort of say, oh, it's okay. Well, that's because other places are growing at sort of 60 to 80%. So 20%, 25% is a bit meh when you've got other places growing more. But I mean, gosh, shouldn't be too unhappy with 25% growth, should we? Um, so anyway, there's a lot of analysis that's gone into this article to just try and sort of get my head round what's going on. As I say, life insurance, I think we've covered that already once, but life insurance isn't in the numbers yet, but that's a potential upside in 2026. Digital transformation, again, it's not there, obviously there in the numbers, apart from that Pakistan 3Q25 jump. Kind of looks like there's something going on around that, but maybe it's too early to see. But certainly in the full year numbers for 2025, if we see more evidence of, well, I mean, and plus in the full year numbers, of course, we're going to have not only the growth of the loan book, but also what the costs are looking like. So, I mean, if we see a reduction in cost, it's not just about sort of growing revenue; it's also about just serving customers more efficiently, but also just driving down the level of portfolio at risk. The overdue payments, or indeed the bad debt. So there's sort of jury's out with it, but potential upside. You'd like to think that all this digital transformation will will deliver a lot of benefits. Um, what I've done next is I've updated my GDP growth just to kind of bring through where possible the growth rate in the current in 2025. So in my last article, I said these countries on average are growing at 7.2%. Well, in the first half of 2025, the average is 5.3, so it's still extremely good, still extremely robust, but slightly lower than last year. But at the same time, I mean, historically, well ahead of many prior years. I mean, it's only really these 17, 18, 2021, which is obviously the COVID bounce back, that that we sort of saw higher numbers, and I think that's just sort of based upon available data. So we don't have any data for Myanmar, for example. Yeah, and I think with some of them, we only had data up till the first quarter, up till March. So I've just used what I could, which is sort of, obviously it's not all places are going to be as up to date as others. And I suppose the point that I was making in my original article, and I've just lifted this from that, is that in the future, there may well be countries that are the richest, largest economies in the world that today are sort of seen as developing world, or third world, or whatever. Um, I think I think it's one of these things that it can be very arrogant to assume that just because you know the past is the past. That, for example, we were fifth in the world back in the 80s. We were fourth in the world in the 2000s. We're maybe sixth in the world or seventh in the world today. I think we're probably seventh or eighth actually in 2025. But you can sort of see like Europe are the purples, and there's three Asians and one North American. That the future is. What do they say? The 21st century is the century for Asia. One, two, three, four, and Africa is making their presence felt as well. Two of the top seven will be African, and the US will be third place in the world. That will be a very different world, won't it? Okay. Okay, valuation. So I'm sort of moving towards the end of this article now, and as you can see, there's a lot to read and absorb, and it's yeah, there's a lot of detail. So I've redrawn this. The market cap now is up here. It's $250 million. Revenue is this line here, so we can sort of see, again using this first half times two approach, that the annualized revenue would get you close to that 250 million. This here then is my operating profit, or ASAI's operating profit, more to the point, and then net income kind of gets you to about 53 million, and that's the statutory 26.7, I think it was, times two gets you to that 53. So that's kind of how it looks today. And of course, that number relative to that green line, I mean, that's where I'm getting the below 5 times earnings from, because that's what it would be. To my mind, 5 times is pretty cheap. I mean, that's incredibly cheap for something that's growing as fast as it is. And okay, yes, you've got to sort of think about risk, but yeah, so you wouldn't sort of value this at 20 times or 30 times or 40 times, but I think 5 times just seems incredibly cheap for what it is. And we also, yeah, so I sort of make the point about yeah, and it's down from 5.8 in the last article, so 5.8 down to 5. But that's just based upon the first half 2025 results. Um, I mean, when you consider that the trading update, as I just flashed up on screen earlier, shows there's a significantly exceeding the 48 million point three consensus, so 48.3 being just below this grey line here of 50. The consensus apparently was that, so it's going to significantly exceed it. Well, it seems to me that it's very unlikely to be at 5 times price earnings. It's going to be lower. It's going to be at well, what would significant look like? I mean, I sort of say, would significant be 10%? The number I came up with by doubling up the first half number? I don't think so. 10% wouldn't be a significant number. For me, significant would probably be 30 to 40. I mean, everyone's different, but um, like a 10% beat is not significant in my mind. So if I'm right, and if net income is 68 million in 2025, um, what that would also then mean is that on average, the 3Q25 and the 4Q25 results were about 22 million per quarter, because the first quarter is the 26, of course. So 68, that's kind of where I'm getting the two lots of 22 from. So it'd be a 44 difference. That would take you to a 3.9 price earnings, 68 million. But if we're on a run rate of 22, and if that run rate can be maintained, bearing in mind that things are growing, they're not shrinking apart from India, where they're exiting. Um, is it that hard to think that 88 would be at least the run rate? To my mind, that seems a reasonable thing to be thinking about. Um, 88 compared to 250. I mean, we're now into the realm of below 3 times. It's 2.9 times price earnings. So um, I think there's quite a few things to say. The net interest margin has risen. The portfolio at risk has fallen to very low levels, 2%. It's also the case that the actual credit losses, which of course were quite high under COVID. So I guess if something like that happened in 2026, we had another COVID, or we had something else, whatever that might be, then yes, that could blow a hole in the side of this. Definitely could. It did during COVID. However, on the face of it, credit losses are very low. The net income. I mean, this is, as I say, this is based upon the extrapolation of the this is a quarterly number, of course, that this is the 22 million that I'm tracking here. So this is the result in the first quarter, second quarter. And that's the other thing to say, actually, is that based upon taking the proportion of the first quarter, second quarter, that we saw growth between the first and the second. And that's what we see here, is that to my reckoning, based upon this loan book size, the net profit, which was 26.8 overall, broke out into 12.4 and 14.4 here and here. So we also see rising numbers of clients, rising numbers of loan book. Obviously, you need more loans to make more income. You need more clients to make more loans to. So these all sort of these growth metrics all sort of feed into one another. That what I would say would, if we kind of look at the assumptions I'm making here, that um, I'm not really making any assumptions here, other than to sort of say, well, this is what's already happened. So we've got the OLP at 555 and so on. But what we've also then got to kind of think about is to say, well, what's going to happen in 2026? I mean, this doesn't stand still. So not only have we got a significant increase in 4Q25, what is significant? Is it 30 to 40%? Let's say, let's say it is. Let's say that the run rate is 22. Does it stop there? If we're saying, oh, in 2026 it's going to be 22 million, there's going to be no growth. The growth just stops overnight somehow. Doesn't seem realistic to me, especially when the 12 months up until the end of September, which was what, 2 months ago, like that growth is not slowing down. If I just go back to it, which was this chart, sorry, this chart here, you can sort of, I mean, okay, Ghana, it's gone from 80 to 60. It like, is that a slowdown, or is that just sort of, and I'll come on to Ghana in a minute, actually. But like Nigeria, it's pretty solid. Sierra Leone, solid. Kenya, okay, Kenya, it has decreased, but it's sort of steady there and there. Growing fast in Uganda, growing in. These are not sort of tailing away to zero or anything close to it, as far as I'm concerned. That it wouldn't be, to my mind, logical to think that there'll be zero growth in 2026 either. Obviously, there's GDP growth, there's growth in numbers of customers, and so on. So, yeah, so I kind of put my thinking cap on a little bit to say, well, what does growth look like? I mean, what would cause it to continue to grow? And I sort of said, oh, there's a bit of a slowdown in Ghana. So I kind of started thinking about this, and I thought, well, what are the factors that would make it grow faster or slower? And I came up with a couple of things. I mean, and this isn't an exhaustive list, but what I've done is I've said, well, how many people are there in Ghana? Okay, so I've kind of got like, 2025 populations. How many branches, and these are the latest, 3Q25, number of branches in each of these countries. How many thousands of customers do they have? So, like, what sort of percentage of the population has a loan with ASAI? Now, Ghana has an amazing, one in 150 people, one in 150 Ghanaians use ASAI to borrow money. Okay, so they've got a loan from ASAI. What that then made me start to think is, well, okay, great that they've had this 80% growth rate and it's now dropped to 60. Like, is it going to carry on at 60% when you've got one in 150? Maybe. I mean, I don't want to be sort of negative, but like, we're already like, per person of the population, on average, people have borrowed $3.12 per person. So what I'm doing is I'm taking that number, 110 million, dividing it by the 35 million to kind of come up with $3.12. The latest rate was 63%, and I sort of said to myself, well, okay, let's imagine that drops off by 80%. So the growth moderator would be, I'm only going to include 20% of that, and I'm going to basically take, so that's about what, 12.5%. And I'm going to take 12.5% of that number there as the growth forecast for 2026. Now, this isn't sort of anything other than a stab at being scientific. And Of course, there are other factors other than these factors, you know, like, of course, like, have they had the new banking software? Pakistan has, Ghana, sorry, will have, or has had, sorry, it happened in October. Tanzania will have in early 26. So there's other things as well. But I kind of said to myself, well, if there's a good level of branches, if there's a low level of saturation, if there's a good level of growth, I kind of came up with these percentages of like, I'm going to include 100% of this growth rate or 50% of this growth rate. So I'm, here, for example, I'm assuming 50% of 9%. So I'm assuming 4.5% of that number there. And that's what I'm getting, that 2.88. Anyway, long story short, I come up with a number of growth of 120, or sorry, 119 million. 119 million on top of the 555 million, and then you've got to sort of think, oh yeah, actually there's also the 4Q25 growth as well. So that plus that gets you to about 670. So I've kind of said 700. I'm going to round it up because of that extra quarter by the end of 2026. So the run rate going into 2027 would be around that number there. And we're currently at sort of 39 point, what was it, 39.6. I'm going to drop that back a little way to 39. So it's slightly below where it is today. That's how I'm coming up with that 273 million of revenue. And yeah, and I suppose my model, I'm kind of saying, net income, remember, 22 million per quarter. So I'm kind of saying, I reckon for 2026, 90 million. So just a slight, again, that's pretty conservative to my mind. If 2025 is 22, 22, 30 to 40% significant, then I'm only really saying it's going to grow by what, like 3% profit growth in 2026, which might be ridiculously too low. But let's say that that's right, because there's quite a bit of wriggle room in those numbers as well. And also, I'm saying the exit rate would be 100, okay, but the average for the year would be 90. So in other words, I do see it growing from 88 to something higher, but there's a bit of wriggle room in there. I mean, all of that kind of implies, I mean, based on that number there, 2.5 times, that kind of implies a valuation of about $630 million. Now, um, I did all of this just myself, and then I sort of thought, I wonder who else has sort of done forecasts on this. I found a broker note, and I compared my numbers against theirs, and it was quite funny because on some things I sort of massively am in agreement, and other things I thought, okay, we're completely different on these metrics. So let me sort of explain what those are. I mean, they came up with that number of revenue in 2026, and that's my number. So we're sort of zero point 0.7 of a million different to one another. I don't know how I mean, they don't say how they arrive at their numbers. I've told you how I arrived at mine. Blah, 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 all of that I just said. So I thought, oh, okay, I feel, okay, we both think the same thing. That's good. Um, but they did say, yeah, they did say that the 2025 revenue would just be that, which implies that the revenue would be that, which because we know that the revenue was that in the first half of the year. So, is that sort of increase of revenue significant enough? 13 million, or 14 million? I kind of thought, don't really agree with that, but we'll see. Um, and then the net income in 2026, they came up with 62 million, and this is where we're very, very worlds apart. I'm saying 90, they're saying 62. So one of us is wrong, deeply wrong. Theirs is kind of 15.6 million per quarter, mine is 22 million a quarter. And I just sort of said, like, if you agree and believe that, 68 for that year, where sorry, tell you what, let me go and find it a different way. Let me chuck it up on screen here. So if I just do this and into here, So yeah, so if we kind of say, if we're happy that this number is about right, so it's grown from that to that, and I'm sort of saying, a 68 million outturn for 2025. I suppose that's the question, isn't it? That is this? But what I've done here is I've taken the 39.6 based on that. Um, yeah, personally, I don't think that's too much of a stretch. Don't think that's too much of a stretch. So anyway, yeah, so we're quite apart on the income. I sort of see my model shows that it's gonna um, because actually, I mean, you know, look at the growth like here 2 million, 7 million, 12 million, 14 million. Obviously, that's based upon the loan book has increased by about 50%. The revenue, have I got the revenue in this chart? I don't think I've got it over here though. If we say, the revenue, there we go. Revenue, I mean, 160, 228, 229, revenue's not really risen by very much. So yeah, I, I, I would venture to say that I think I'm going to be closer than they are. But look, I mean, whoever is right, or if neither of us are right, who knows? I mean, these are only just sort of extrapolations of evidence, I guess. But like, if they're also sort of, applying a 7 times valuation, um, I mean, they get to £3.35. I get to £4.75, or $6.30, which is £4.75. Um, I mean, that one is what 50% higher. That one is sort of 130% higher. But yeah, either way, I think there's definite ups. Well, it feels like there should be upside. I can't say there's definite upside, but feels like there should be upside from where we are now. So to conclude, I guess it's gone up 76p since I wrote my article. So it's gone from 128 to 2020, or 126 even to 204. So it's gone up a fair chunk. I like the idea that it benefits people that take these loans 94% of the time. I mean, you can't keep 100% of people happy, but if you can do that 94% of the time, you're doing some good in the world. So I like that. I like that it's got a good dividend that's going to grow. As I say, I haven't sort of made any attempt at saying how much it's going to grow by, but it wouldn't surprise me if we saw something like a 4 or 5% yield on this in 2026. And of course, the bit that I suppose I did talk a lot about was how the loan book is growing and therefore it's swallowing up more and more working capital. But at some point, a little bit like Greg's, same sort of thing. At some point, it flips over and it no longer swallows extra and extra working capital. Instead, it starts just generating serious amounts of cash, and you can sort of see, it's sort of that blue line is sort of starting to turn positive, and if it's generating something like uh, you know uh, operating cash flow into substantial numbers, then that obviously frees up money to go into higher and higher dividends. So it does feel like one of these ideas that could generate a really good stream of income over time. But equally, I mean, when things are growing as fast as they are, I mean, don't be overly surprised if there isn't vast amounts of available cash flow to increase the dividend. But what you're getting is, as I showed you, the shareholders' equity grew from 72 to 102, and that's a 40% increase to shareholders' equity. And of course, that shareholders' equity is post-dividend. So the dividend would sort of be a reduction from shareholders' equity, essentially. So, keeping the money within the business when it can grow as fast as it's growing and implement new systems and establish itself into these markets that are fast growing. I kind of like, and at the end of the day, there's nothing really that the UK government can do that, if they kind of introduce new taxes or whatever they do, doesn't really make any odds to the amount of loans happening in Ghana. I mean, it's sort of like the butterfly flaps its wings and there's a storm in China or something that there's almost sort of no connection. So this is kind of, I like the idea that it's disconnected from other parts of my portfolio that are pretty reliant upon the sentiment of the UK consumer. Things like Greg's or other ideas in the picks for 26. Anyway, that's enough from me. If there are any questions, I'm happy to you can use the chat and ask them. I mean, if I could ask you to like the article if you like it. If you don't, then don't. But why are you watching it? So yeah, I'll be releasing this article, and obviously there's a lot to digest, a lot of analysis that I've been doing on the numbers, but hopefully that's a useful insight and kind of backs up the reason why I included it, and also just to sort of say as well. It was a few weeks ago that I increased the holding of this by three times. So I increased it from an imaginary 1,000 to imaginary 3,000 in the portfolio. There's three ideas that I did this for. This was one of them. And it was because, even at the time I said to myself, well, it's dropped back in price for no good reason. Whilst I hadn't deep dived into the interim results and the third quarter results, I'd seen enough to know that there was that margin of safety. And I guess now I've kind of gone into the minutiae of it. I'm delighted to have increased, the relative holding in my imaginary picks for 26 because I think it will do well. But yeah, as I say, none of this is investment advice. You make your own investment decisions, usual stuff. But thank you for watching, and cheerio from the Oak Bloke. Cheerio for now. Cheerio.